Welcome to our video on finance and investing with William Amman. In this video, we will delve into the world of finance, exploring key concepts and strategies that can help you make informed investment decisions. Whether you're a seasoned investor or just starting out, understanding the fundamentals of finance is crucial for building long-term wealth. Financial literacy is not just about knowing how to manage your money. It's about making smart choices that can secure your financial future. Just like running a successful lemonade stand requires careful planning and decision-making, investing wisely involves strategic thinking and a long-term perspective. By the end of this video, you can expect to gain valuable insights into the world of finance and investing, empowering you to take control of your financial journey. Let's dive in. Debt versus equity. Understanding the basics. When it comes to finance and investing, understanding the differences between debt and equity is essential. Debt financing involves borrowing money that needs to be repaid with interest, while equity financing involves selling a stake in the company in exchange for capital. Debt financing gives the lender a claim on assets and cash flows but does not dilute ownership. On the other hand, equity financing involves sharing ownership and profits with investors. Debt typically carries lower risk but higher interest costs, while equity entails higher risk but potential for greater returns. Choosing between debt and equity can significantly impact financial outcomes. For example, taking on too much debt can lead to financial strain, while diluting equity too much can reduce ownership control. Understanding the implications of debt and equity is crucial for making informed investment decisions. Raising capital through IPOs. An initial public offering, IPO, is the process by which a private company offers shares to the public for the first time, allowing it to raise capital by selling ownership stakes. This significant event marks the transition from a privately held company to a publicly traded one, enabling investors to buy and sell shares on the stock market. IPOs offer several benefits for companies, such as access to a larger pool of capital, increased visibility and credibility, and potential for future fundraising. However, going public through an IPO also comes with challenges, including regulatory requirements, increased scrutiny, and pressure to deliver consistent financial performance. For investors, IPOs present opportunities to invest in promising companies early on and potentially benefit from their growth. Understanding the impact of IPOs on a company's growth and investor opportunities is crucial for making informed investment decisions in the dynamic financial market. The importance of early investing. Starting to invest early can have a profound impact on your long-term financial security and wealth accumulation. By investing early, you give your money more time to grow through the power of compounding returns. Compounding allows your investment gains to generate additional returns, leading to exponential growth over time. Long-term investment strategies offer benefits such as financial stability, wealth preservation, and the potential for achieving financial goals. By staying invested for the long haul, you can weather market fluctuations and benefit from the growth of your investments over time. For example, consider two individuals who start investing at different ages. The one who starts early and consistently invests over time will likely accumulate significantly more wealth compared to the one who delays investing. The key takeaway is that the earlier you start investing, the greater the potential for long-term wealth growth. Investing in established companies. Investing in established companies with a proven track record can offer stability and growth potential for investors. These companies have a history of success, established market presence, and a track record of generating consistent profits. By investing in such companies, investors can benefit from steady dividends, capital appreciation, and lower risk compared to newer or unproven companies. When evaluating established companies for investment, it's essential to assess factors such as financial performance, competitive positioning, industry trends, and management quality. Look for companies with strong balance sheets, sustainable business models, and a history of delivering shareholder value. To identify solid investment opportunities, conduct thorough research on company fundamentals, industry dynamics, and market trends. Diversifying your portfolio with a mix of established companies across different sectors can help mitigate risk and maximize long-term returns. Understanding financial statements. Financial statements, such as balance sheets and income statements, are essential tools for assessing a company's financial health and performance. The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time, while the income statement shows the company's revenues, expenses, and profits over a period. Interpreting financial ratios and metrics derived from these statements can help investors gauge a company's profitability, liquidity, solvency, and efficiency. Ratios like return on investment, ROI, debt-to-equity ratio, and earnings per share, EPS, can provide valuable insights into a company's financial strength and operational efficiency. Financial statement analysis plays a crucial role in making informed investment decisions by helping investors assess the risks and potential rewards of investing in a particular company. By understanding and analyzing financial statements, investors can make more informed and strategic investment choices. Avoiding excessive risk. Excessive risk-taking in investing can have detrimental consequences, including potential financial losses and jeopardizing long-term financial goals. When investors take on too much risk, they expose themselves to heightened volatility and the possibility of significant downturns in their investment portfolios. To manage risk effectively, investors can employ strategies such as diversification and asset allocation. Diversification involves spreading investments across different asset classes, industries, and geographic regions to reduce the impact of any single investment's performance on the overall portfolio. Asset allocation involves determining the optimal mix of assets based on risk tolerance, investment goals, and time horizon. Balancing risk and return in an investment portfolio is crucial for achieving a healthy risk-adjusted return. By diversifying investments, allocating assets strategically, and periodically reviewing and adjusting the portfolio, investors can mitigate risk while aiming for long-term growth and financial stability. Building a diversified portfolio. A diversified portfolio is a collection of investments across various asset classes, such as stocks, bonds, real estate, and commodities, designed to spread risk and enhance long-term returns. Diversification is crucial for risk management as it helps reduce the impact of market fluctuations on the overall portfolio. By spreading investments across different asset classes, industries, and geographic regions, investors can lower volatility and potentially increase returns over time. Diversification allows investors to capture the benefits of different market cycles and reduce the risk of significant losses from a single investment. To build a well-diversified investment portfolio, investors can consider asset allocation strategies based on their risk tolerance, investment goals, and time horizon. They can also utilize investment vehicles such as mutual funds, exchange-traded funds, ETFs, and index funds to gain exposure to a broad range of assets while maintaining diversification. Paying off debts before investing. Prioritizing debt repayment before diving into investment activities is crucial for achieving financial stability and long-term growth. High-interest debt, such as credit card debt or personal loans, can significantly hinder investment growth by eating into potential returns and increasing financial stress. By clearing debts first, individuals can free up funds that would have otherwise gone towards interest payments, allowing them to build a solid financial foundation for future investments. Eliminating debts can also improve credit scores, reduce financial burdens, and increase disposable income for investing. Creating a debt repayment plan is essential before embarking on investment ventures. Start by listing all debts, prioritizing high-interest debts, and allocating a portion of your income towards debt repayment each month. Once debts are under control, you can redirect those funds towards building wealth. Through investments, setting yourself up for financial success in the long run. Aligning interests with money managers. Choosing money managers who prioritize client interests is crucial for achieving successful investment outcomes. When the interests of investors and money managers are aligned, it fosters trust, transparency, and a shared commitment to achieving financial goals. Conflicts of interest can arise when money managers prioritize their own financial gain over the best interests of their clients. This can lead to biased investment decisions, hidden fees, and subpar performance, ultimately impacting investment outcomes negatively. To select trustworthy and transparent money managers, investors should conduct thorough due diligence, assess track records, and inquire about fee structures and investment philosophies. Look for managers who prioritize client interests, demonstrate transparency in their practices, and have a track record of delivering value to investors. By aligning interests with money managers who prioritize client success, investors can enhance their chances of achieving their investment objectives. In this video, we've explored essential concepts in finance and investing with insights from William Amman. We've learned the importance of early investing, the significance of diversified portfolios, and the impact of aligning interest with money managers. By understanding financial statements, managing risks effectively, and prioritizing debt repayment, viewers can take proactive steps towards financial security and wealth accumulation. Remember to subscribe, like, and share this video for more financial education and insights. By staying informed and continuously learning about finance and investing, viewers can empower themselves to make informed decisions and secure their financial future. Explore related content on finance and investing to deepen your knowledge and continue on the path towards financial success. Thank you for watching, and here's to your financial well-being.